Good day, fellow investors. I truly enjoyed Michael Burry's and Lewis's podcast where, after 15 years of silence, we finally have an interview with Burry. Really suggest to watch that podcast. I'll put the link here in the description below. The topics were the investing difficulties, even if he made so much money for them, to investors, that once in a century crisis floods happen every 10 years, the 10 million put on Nvidia and Palantir that has been bastardized by the media to 1 billion short positions. However, the key here where I want to focus is that the stock market has a number of bad years ahead. He discusses, you can listen to the podcast, Palantir short, how IBM has a better business similar that they do, AI bubble, debt concerns, but you never know when that will become a concern, the Fed should be cancelled, and even mentions the Bitcoin. But let's focus on the stock market ahead has a number of bad years, and the topics there are comparing to 2000s, how the whole thing might crash, not just what was in the dot-com bubble because of the passive. The bubble usually pops before the capex peak. 2 years of put options is enough to protect yourself. Have some healthcare, gold, he's been in gold from 2005, sell what shot up already, and buy value. Found the transcript, very nice, and he doesn't manage any money anymore. So why did he decide to do that? Because I think we are in a bad situation for the stock market, could be in for a number of bad years, and I could be a longer bear market, more aching to the 2000s. And then everything has changed, everything has switched to passive money, but in general is that he doesn't want to be on the investment management side and deal with investors during those bad times. And he says, if the market goes down, it will not be like the 2000s where there was this other bunch of stocks that were being ignored. However, everything will come down now, the whole thing will crash. And it will be very hard to be in a long stocks position in the United States and protect yourself. And that's why he decided to get out of money management. As he says, he didn't want to go through investors again. The question is, okay, is there a timing argument for the AI bubble? Awful a lot like the dot-com bubble, which is not really a dot-com bubble, but it was a data transmission bubble. It was a huge build out of fiber. Huge fiber needs routers, routers need fiber, and it just blew up. So the market peak was in March 10th of 2000. Cisco still grew, kept growing next year. And what you see in every prior bubble was that the relevant stock market peak was before you were even halfway down with the capital expenditure. In the majority of cases, the capital expenditure hadn't even peaked yet. And so we are ramping capital expenditures, and what's happened is we've gotten into a part of the phase where if you announce $1 of capex on AI, your market capitalization goes up $3 for every dollar you have. We saw that with Oracle, how's that's going out, building out. However, he feels that 2-year puts will be enough for this bubble to pop. And AI and everything will be commoditized. So if that is commoditized, we discussed just yesterday the 1.9, hopefully that's positive, S&P 500 yield. So let's discuss this a little bit more in detail. 2000s, okay, looks bad, but now we are in a passive market. The best video I can offer you on that is stock market investing is broken, algos, passive, and retail. And nobody's thinking now in the market, passive is 60%, the rest is algorithms, and the retail investors, all mostly gamblers, nobody's thinking. So just 10% of trading is regular stock picking, and therefore nobody is thinking about returns. Nobody is therefore thinking also about the 1.9% yield that we just recently discussed, likely even lower. And the thing turns when people start, okay, at some point it cannot go up forever. Then when people see, okay, that's not going up any likely, and the yield is nothing, that is when the flows will start reverting, and that's what Burry says, everything goes down. And the bubble usually pops at capex peaks. And we can see here Burry's chart. So I found this on the internet. Nasdaq all-time high, energy, shale revolution, housing bubble.com. Total capital expenditures less depreciation, nominal US GDP. So it's a pretty cyclical thing, and the bubbles usually peak earlier. Once in a lifetime happens more often than that. And he says, buy value, gold, whatever, sell what is up, and you will do fine. I completely agree with Burry. I'm just not timing it, so I'm not going to bet 10 million or a billion in put options on that. I'm thinking, if I'm wrong, if we are wrong, or he's wrong on the prediction, maybe it's not 2 years, maybe it's 3 years. You can never know that. And that's how I want to be invested, so that whatever happens, whenever it happens, I'm okay. So the market is expensive now, low returns, there are some pockets of value. So we try to discuss them here and there. On the debt government issue, again, you never know when is that going to pop. It's still the United States, it's still the dollar. There are many levers that can be pulled, but it is certainly unsustainable. He calls for the cancellation of the Fed as a useless situation there that makes things only worse. That's also an interesting topic there. The most important, watch the video. It's really something, a must watch if you want to learn about investing in general from a little bit different perspective. Sell if you have something that's bubblicious, go to cash like Buffett, or go to value like Burry, or even put options. So let me know what you think in the comments.